Well, hello everyone. Thanks for joining us today. This is Advanced Underwriting Consulting's regular webinar conducted the first Wednesday of each month at this time. Today's topic is numbers you need to know in 2018. We'll make supporting materials available to those of you who are attending at the end, and we'll tell you how to get those materials. My name is Linus Sujas. I'll be both host and presenter today. For those of you whom I have not yet met, here's a little bit about me. I've been a lawyer for about 35 years. I've been associated with the life insurance business for about 30 of those 35 years. Spent some time in the home office. I'm currently out on parole, but much of my home office career was spent in the advanced sales department. After I had my home office career, I had an estate planning law practice here in the Middle Tennessee area, specifically in Franklin, Tennessee. And I met with the kinds of folks that I suspect some or all of you also meet with. And I'm going to use all of that background, lawyer, life insurance, entrepreneur background, to try to make the stuff we're going to talk about today related to tax and technical and numbers useful for you to use in your own businesses. I hope that you'll find that the next 15 minutes or so that we're going to spend together is going to be productive for you. So we're going to talk about 2018 numbers and what's changed from last year. There are two primary sources of changes. First are the cost of living changes that we have every year. The changes to a lot of the numbers that are tied to the consumer price index, those numbers have altered slightly. But there have been some more major changes related to the Tax Act that was enacted in late December, the Tax Cut and Jobs Act. And so very much has changed, starting with the income tax rates and income tax brackets. There are significant changes for both individuals and businesses. We're going to talk primarily about the individual changes first. We'll touch on the business changes. If you want to hear about this, the business changes in more detail, feel welcome to sign up for next month's webinar, which I'll talk about at the end of today's broadcast. So these are the new tax brackets for 2018. There's nothing there on the chart to compare it to 2017. I will make a couple of observations. First of all, both the rates and the brackets have changed compared to 2017. The breakpoints on the changes in the tax rates are similar to those from 2017, but the tax rates are either equal or lower than they were last year. For example, the top rate last year was 39.6. The top rate now is 37%. What does that mean for our clients? Well, I think it means that if taxable income is the same in 2018 as it was in 2017, our clients' actual income tax liability is likely to be the same or lower in 2018 as it was in 2017. And that was, in fact, what Congress and the President were saying while this was being negotiated. That much is correct. Whether taxable income is going to stay the same from one year to the next depends on a lot of different things, including what I'm about to mention next, the standard deduction. So, the President, in his State of the Union address, reinforced the idea that the standard deduction nearly doubled from 2017 to 2018, and that part is fairly accurate. The standard deduction for married filing jointly in 2017 was $12,700. It's now $24,000. That's almost doubled. Likewise, for single taxpayer in 2017, it was $6,350. Now it's $12,000. That doesn't mean that every taxpayer is going to see double the benefit. and that's in connection with the way that the standard deduction works. Now, we talk a lot about itemizing expenses and being able to deduct certain kinds of expenses. And so the standard deduction is an alternative to itemizing. What do I mean? Well, if you add up all of your itemized expenses, all the expenses that are eligible to be deducted, and you add all of those up and you compare it to the standard deduction, if your itemized expenses are bigger, they produce a bigger number, then you're going to itemize, and the standard deduction from that point forward becomes irrelevant to you because you're going to itemize your expenses. Likewise, if you have very few itemized expenses, they aren't very big, you're going to choose the standard deduction. And so for those who did not itemize in 2017 and did not expect to itemize in 2018, the increase in the standard deduction is really a big plus because it means that instead of, for married filing jointly, 12.7 coming off the top of gross income and figuring out taxable income, $24,000 is going to come off the top. And so it's a much lower taxable income for somebody in that circumstance. However, if in 2017 you had a married couple filing jointly who had $30,000 of itemized expenses, for them, their taxable income is going to be the same. Assuming the gross income is the same, their taxable income is going to be potentially the same because they'll have the same $30,000 of itemized expenses in both 2017 and 2018 that they'll take because the itemized expenses are bigger than the standard deduction. So they'll see no benefit from the increase in the standard deduction. And I think it's an important point to know. In addition to the standard deduction being nearly doubled, personal exemptions, which were valued at about $4,000 per person in 2017, personal exemptions are no longer available to deduct against taxable income. And so that means that, you know, the benefit from the increase in the standard deduction probably isn't as big as it might have otherwise been if they'd kept the personal exemptions. Now, I get that, you know, politically that might or might not have happened, but, you know, at the end of the day, there's a lot of moving parts to the question as to whether or not somebody's going to pay less or more taxes, and that's just a little bit of an example of that between 2017 and 2018. Now, I didn't put it on the slide here, but the business income tax rules have changed as well. The pass-through, for pass-through businesses, there is now potentially a 20% business income tax deduction available to the owners of certain kinds of pass-through businesses. And the rules are kind of involved, but I think that's the bottom line. Potentially, our clients who have closely held pass-through businesses may get some benefit from the 20% business deduction. For our clients who are owners of C corporations, the news is even better. In the past, C corporations could be taxed at a rate as high as 35%. Personal service C corporations paid 35% income tax on all of their income. In 2018, going forward, the top C corporation rate has dropped to 21%. And so that's a significant change, and it's a reason, I think, for us to talk to our business owner clients to help them figure out how these taxes might affect them going forward and what strategies they might employ to minimize their tax liability in 2018 and further into the future. So what other numbers have changed? Retirement plan numbers have changed. The limit on includable compensation for retirement plan contribution purposes to $275,000. That's $5,000 up from last year. The limit on the amounts that could be contributed to defined contribution plans, $55,000, up from $54,000 last year. The limit for a payout for a defined benefit plan, $220,000 a year, up from $215,000 a year. The deferral limit for 401k plans, $18,500, that's up $500. But there are some things that didn't change. The catch-up limits that are listed here on the chart are unchanged from the 2017 limits. So even though some numbers have changed, some numbers haven't. And so it's good to have some kind of resource available close at hand to understand what has and hasn't changed. On the IRA front, the IRA contribution limits for those who are eligible are still $5,500, $6,500 for those 50 or older if they are eligible to make contributions. The IRA deduction phase out, the numbers have increased slightly. If you're an active participant in a qualified plan, your ability to make a deductible IRA contribution, if you're married filing jointly, begins to be phased out at $101,000 of modified adjusted gross income, completely phased out at $121,000. If only one spouse is active in a work qualified plan, the phase out begins at $189,000 of modified adjusted gross income for married filing jointly. $199,000 of modified adjusted gross is the level at which the ability to make a deductible IRA contribution is completely phased out in those circumstances. Likewise, the numbers for Roth eligibility have increased slightly, a few $1,000s from the 2017 income levels, except for married filing separately, where the ability to make a Roth IRA contribution is all the way down to the ground. It's curtailed all the way down to the ground. Many of us sell long-term care insurance or talk to people about long-term care insurance. And so for itemizers, long-term care premiums are potentially deductible as a medical expense. So if you've got an itemizer who does itemize and is able to deduct medical expenses, and that's at greater than 7.5% of adjusted gross income, these are the amounts of long-term care premiums that they actually pay that are the maximum that can be deducted as medical expenses. For those over 70, it's the most generous at $5,200 a year. However, in the real world, we recognize that while the numbers have increased from last year to this year, as a practical matter, a lot of the premiums are higher than this, and so a lot of our clients, even if they do itemize and are eligible to deduct medical expenses, are not able to take the full deduction for their full long-term care premium. The age-based limits act as a further barrier for them to be able to deduct their long-term care premiums. This is the maximum that they can deduct in 2018. So President Trump talked a little bit about the repeal of the penalty for failure to have health insurance under Obamacare. While Congress and the President did repeal the penalty, it's effective only next year in 2019. The penalty still exists for failing to have health insurance this year. And you can see from this chart how that penalty is calculated. It's not worth spending a lot of time over it. I have heard anecdotally that that there's going to be kind of a less rigorous enforcement of the penalty tax, perhaps, but in any event, the penalty still does exist, and this is how it's calculated. For many of us on the call, talking to people about estate tax management has been an important part of our business in the past. That's gotten a little bit more dicey with the federal estate tax exemption having been increased last year to about $5.5 million for a single person, $11 million for a married couple. That exemption amount was essentially doubled again. And so for a single person, we're talking about a federal estate tax and gift tax and generation skipping tax exemption of $11.2 million for a married couple. That works out to be $22.4 million, even without any special planning. The estate tax rate, as well as the gift tax and generation skipping tax rates, are still 40%. So if you've got somebody who is married or single with a really high net worth, they still have to worry about federal estate taxes, and we can still talk to them about life insurance in an ILIT to pay for the tax that can't be avoided. However, that's going to be a smaller subset of our client base because the exemptions have gotten bigger. And oh, by the way, the gift tax exclusion, the amount you can give away to any other person without having to worry about any gift tax consequences at all, not even having to file a gift tax return, that was raised from $14,000 in 2017 to $15,000 in 2018. So we have just a few minutes for this today, and I'm not going to go through any more of the numbers, but I will invite you to email us after today's webinar if you would like to have a reference piece that has most all of the new numbers related to pension, tax, Social Security for 2018. Drop us an email, and we'll be glad to email to you a copy of the 2018 Think About It, which has all of those numbers. And I appreciate all of you joining us today. If you want those supporting materials, feel welcome to email us at asktheexpert@advancedunderwriting.com, asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Feel welcome to join us for the next webinar on the first Wednesday of next month, March 7th, at this same time. Next month's webinar will be titled Tax Planning for Business Owners in 2018. And we'll talk in a little more depth about the business tax changes that were part of the Tax Cut and Jobs Act and what opportunities those changes present for us going forward. You can find an archive of our past webinars on our YouTube channel. Today's presentation will also be posted on our YouTube channel by the end of this week. And finally, for more information about the services that Advanced Underwriting Consultants offers, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. Thanks again, and best wishes for continued success.